Invite me to join. Can you see me? Hey, Jesus, it's dark. Holy shit. I'm smiling sheepishly. Hello, can you hear me? I know. Hello, can you hear me? Adeyemi, you're welcome. Good evening, everyone. Wow, you're welcome. Please, if you can hear me, can you raise your hand or drop a chat? I need to know we're together. All right. Thank you, David. Good evening, everybody. You're very much welcome to today's program. You're welcome to this forum. I'm excited to have us all on board. My name is Egwabo Princess. I am a financial analyst and I'll be moderating this program alongside with Mary Ikajagbe. Oh, keep logging in, keep logging in. If you're just joining, you're very much on time. Welcome on board. This is a seasoned and information-filled program, and I am glad to be a part of this. You're welcome. You're welcome. Very quickly, I would give us a run through of what this program entails. I'll give the rundown of the program, and we have rules that I would enjoin each and every one of us to adhere to. That's our contribution to the success of this program. So please, once you have a message, once you have a question, when each speaker is speaking, you're taking down your notes and you have a question to ask, you can drop it on chat. And please keep your microphone mute as you join in so as not to while we proceed. Okay. This is the first edition of the 2020 sorry, I'm having network issues. Sorry for the interruption. Wow. Okay. Okay, that's a better connection now. Okay. This is the first edition of the 2020 RICS Annual RICS Managers Congress, and powered by Sisters Consulting. Is themed RICS Innovation Strategy and Corporate Values. You know, RICS is risky. It's something that can't be avoided. We can't tell what tomorrow tells. We can't tell what tomorrow entails. So at some point in time, we have to make decisions. And, you know, this is just a program with a core objective to see how we can help risk managers improve in their organizations. We're building ourselves and we are building ourselves as better persons. So we have a season with speakers, chartered accountants, and we have 4 sections. So while you sit down, while you're abreast, while you take your notes, each speaker will go through different sections with different topics that are of interest. I'm sure we have seen them. We know what all of this entails. And while you have your speakers speaking, you take note of the details of the topic. You pen down your questions and drop it up in a chat. Thank you very much. At this point in time, I'll just quickly introduce or give a brief profile of all our speakers. We have 3 speakers today. The first person is Usekan Joy. Usekan Joy, she's a chartered accountant. She has over 4 years experience in finance, internal control, internal audit, and risk management. She has a background in economics, and she's a member of the Institute of Chartered Accountants of Nigeria. She's currently the Treasury and Financial Control Accountant at Construction Kaiser Limited. Okay, someone is saying he can't hear me. Uh-oh. Hello, are we still together? The first is Usekan Joy, and she'll be talking on board perspective on enterprise risk management. Board perspective on enterprise risk management. The talk is going to last for 15 minutes, and we're going to have question and answers at the end of that segment. So please, I would like us to take note of that. The second speaker will be talking about fraud risk assessment, and it's no other person than Feyi Togan. Pardon me. Feyi Togan has 7 years experience in governance, risk management, and compliance. He has his first degree in accounting from Covenant University and his second degree in risk management from the University of Lagos. He is a member of the Institute of Chartered Accountants of Nigeria, ICANN, and he is a member of Systems Control and Compliance Group, the Imperial Home at Imperial Home Mortgage Bank. He is going to be taking us on fraud risk assessment. Yes, a 50 minutes talk that would have a section of question and answers for 15 minutes thereafter. So I want you to sit back and know that we are loaded with information for you to keep you updated and relevant in your field. Keep you top notch with industry standards and all. Then our third speaker is no other person than Mr. Ayomi Ladokun. Mr. Ayomi Ladokun. He's two in one. He'll be anchoring two sections. First, he'll talk on risks and resilient innovation strategy. That will last for 40 minutes. Thereafter, he will take questions and answers and proceed on another um, 35 minutes talk on managing risks in a digital world. I bet you don't want to miss that. Managing risks in a digital world. Yes, it's also open for question and answer after the fourth talk. Mr. Ayo Ladokun a is a man with over 10 years experience in finance, audit, internal control, governance, human capital management, and risk management. He has a background in banking and finance, and he's the mentor at the he's a member, sorry, of the Institute of Chartered Accountants of Nigeria, ICANN. He currently works with May and Baker Nigeria PLC as a risk assessment manager. Now, at this point, I'm sure you are sure you're going to get nothing less than the best from this forum. If you're just joining in, you are still on time. Please, as you come in, make sure you mute your mic so there will be no interruption as we proceed into this. My time is 10 minutes past 7. Join me as I make welcome our first speaker for today. Our first speaker for today is no other person than Usekan Joy. She'll be speaking to us on board perspective on enterprise risk management. While you sit back and take your notes, don't forget to keep your minds mute and drop your questions on chat. I'll just hand over to my boss to do to do justice to the topic before us. You're welcome, Ma.
Thank you. Thank you very much. So I'd like to confirm if everyone can see me, you can hear me. I'll just show with a wave of hand. So if you can hear me, just let me know.
Okay, loud and clear.
All right, thank you. So I'd like to share my screen. The host should please give me the permission to do that. Hello? 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 Okay, okay. Uh, okay, so yeah, I'd like to just also confirm if you can hear me, you can see me and my screen. Hello?
Yes, please go ahead. We can hear you.
You can see my screen. Okay, so today I'd like to specially welcome everyone to this webinar. We shall be discussing, our core focus is on risk management. But first, let me thank the organizers of this program, Sea Professional Consults. It's a privilege to be a part of this, and it's one of its kind. So my core focus will be on board perspective on enterprise risk management. What we want to talk about is how the board views enterprise risk management and what's importance of enterprise risk management to the organization. So in a nutshell, in a capsule, this is what I will be presenting to you and our core focus of discussion. So I'd like to quickly run you through what we shall be talking about. I'll be introducing you to enterprise risk management, the key focus of the companies are driving towards to, the board role in risk oversight, risk reporting, and risk oversight and executive management as a defense. And lastly, I'll be wrapping up with the principles in if an organization wants to create an enterprise risk management program. So for the purpose of this webinar, if you hear me say ERM, I simply mean enterprise risk management. So it's same thing. So I could be definitely using them interchangeably. So let's go on. So introduction to enterprise risk management. So enterprise risk management is not actually new to the world, to the corporate world, but it's just gaining more relevance as the year goes by. So I'd like to pick a few case study that we will discuss about. I have about 3 multinational companies that are already well known: Wells Fargo, Volkswagen, and Aeron. So I'll dive deep and we're going to unveil and see how risk management failure affected these companies. So let me start with Wells Fargo. Wells Fargo is the bank. It's a multinational financial service company in America, based in America. They have about branch in over 35 countries. If you're talking about top banks like Bank of America, Citibank, Wells Fargo belongs to the top banks in the world. As of 2015, the bank was even ranked the world largest bank in terms of market capitalization. So you could say that the bank it's a big one. It's a big brand. So what went wrong? As of 2016, the company, what happened was that its employees created fraudulent accounts for customers. The board was trying to drive a profitability mantra. They wanted to increase its profits by driving in 8 new products to its customers. For the employees to meet this target, they went into fraudulent practice by creating fraudulent accounts for its clients. Let's see what the implication of this went. They ended up charging customers accounts for what they knew nothing about. These accounts were created without their consent. Okay, these accounts were created without their consent. So they ended up charging customers. People lost their mortgage. Funds were lost as due to the illegal charges. We have reputational damage to Wells Fargo, and over 5,000 employees were laid off. The company had to pay a fine of over $1 billion. So you can imagine as at today's rate what $1 billion would be like. And this is said to be the highest fine paid to customer protection, financial protection bureau body. So it's risk management, it's very crucial. I've tried to explain what happened here with Wells Fargo. So it's necessary that even if you're at the top, you feel you've arrived as a company, risk management practice must continue to be in place. As to date, Wells Fargo is still managing the crisis of what happened in 2016 and currently withdrawing from retail banking. So let's look at Volkswagen. It's also not, it's a well-known company into automobile. What happened? There was a violation in a clean air policy. They violated a regulation, emission pollution. That was the violation that occurred. They went ahead to release vehicles to the public that did not meet up to the standard of its quality, of what the regulatory bodies expected. So they also had to pay a fine of about 2.8 billion. This is Volkswagen. They've spent over 18.32 billion in recovering those vehicles from the public and trying to rectify what has happened. The head of development was also suspended as a result of this. So we can see that risk management, if you put in the right, if you do what is right at the right time, they wouldn't have had the need to spend so much in rectifying the damage that has happened. So Aaron, this is one very popular one. This is what I would like to say. How has the mindset fallen? Aaron was for 6 years the most innovative company. They won that award. So what happened? How did they just go from being top there, an energy company, and now they're not in existence? So what happened? Aaron was falsifying its accounts, giving fraudulent reports, trying to hide its huge amount of debt, giving this is a false image to his shareholders and to his stakeholders. And they had the help of Arthur Andersen in doing this. Today, Arthur Andersen and Aaron, they're nowhere to be found. The company has crippled. So risk management, it's very crucial. I'm just wanting us to have a view of what risk management, how important is it by using this case study. So I've spoken about the effect from the case study, but I'll just try to run through this. So we have reputational damage, we have civil liability, revenue loss, data loss, bankruptcy. You can just classify them into financial risks. So the effect of poor risk management in an organization could cost the organization a lot. It is very important that ERM is put in place in an organization. Okay, now I'll talk to you about, this is a definition of how COSO. COSO is a body involved in risk management, how COSO defines enterprise risk management. It says enterprise risk management is a process effected by an entity's board of directors, management, and other personnel applied in strategic settings and across the enterprise. So I'm going to put a pause there. You can say that enterprise risk management, it's a process and it goes from top to bottom. You can see they started with the board of directors, then the management and other personnel. So risk management is for everybody in the organization, from the board of directors to the management and to the other personnel. So it's for everybody. So I'll continue with the definition. It said it's designed to identify potential events that may affect the entity and manage the risk. So what risk management does is it helps you to identify the potential risks that may affect the entity and how you're going to respond to this risk. That's where managing this risk comes in. You don't just want to identify, you want to manage, you want to make sure everything is in place and to be within the risk appetite of the company. Risk appetite simply means the level of risk a company is willing to absorb. This is my risk appetite. This is what level of risk we are willing to accept in order to drive our objective, to provide a reasonable assurance regarding the achievement of its objectives. So I've introduced you to enterprise risk management, ERM. By the definition, I've been able to break it down to say, okay, enterprise risk management is for everybody. What it helps you do is to identify your risks, manage it within your risk appetite. Okay. So let's see how popular ERM program has been over time. This research was conducted by Deloitte Global Risk Survey. So you can see it's a percentage of organizations with an ERM program in place. As at 2006, we had 35%, and in 2018, we have about 83%. So there's been an increasing need for ERM program to be in place in the corporate world. In 2020, I can forecast that if this survey is being done, there's going to be a massive increase due to the black swan risk, COVID-19, that hit many organizations. So people before now that were not incorporating ERM program in organizations based on the effect of the COVID-19 pandemic, they've been forced or we've been able to recognize that ERM is necessary program to put in an organization. So by 2020, I'm expecting that this percentage would have really gone up than this. So now talking about, let's talk about the key focus. Prior to now, the board of directors were more interested in the operational, compliance, financial approach. What it means that the information the board members want to know is our daily operations going on fine. Fine, it's fine, they're fine. Compliance, are we paying our tax? Are we doing the right thing? Are we conforming to the standard of procedure set by external bodies? Financial, they wanted to know, okay, are we doing well financially? So this was most of the information. This was just really what the board of directors were really after. But over time, there's been a shift of focus, which is the strategic risk. Strategic risk is one that directly impacts the company's identified strategic goals. So we can all agree with me that the board of directors and executive management, they're in charge of setting the strategic goals and objectives of the company. What now the key focus is that these goals and objectives, what are the strategic risks that could directly impact the company's identified goals? So now let me go back to our first slide where we talk about Wells Fargo. What the board wanted to achieve was profitability and sell 8 products to its customers. What they didn't look at is risk assessment to identify, okay, what are the risks for us to achieve these goals and see how well they can manage it. See how well they don't go beyond their risk appetite. So this is what strategic risk is all about. You are looking at things that can directly impact the company's goals and objectives. It could be political risk, it could be economic risk, it could be legal, social economy. So it's spanned about a lot of risk. So it's more of a holistic view of ERM, looking at the strategic risk. So let's look at the board role in risk oversight. So it is important that the board of directors drive risk management in an organization. Most times, some companies would like to, they will have a board risk committee. Even if they have a subcommittee for risk management, it is important that all boards are involved in risk management. So what's their role? What are they meant to do? They're meant to understand the risk philosophy and concur with the entity's risk enterprise. Like I said before, the risk appetite is the level of risk that an organization is willing to accept. This is our threshold. This is what we can accept. So it is the board of directors, their duty to say, okay, they understand the risk philosophy and it concurs with the entity's risk appetite. So secondly, they also try to know the extent to which management is driving ERM program in the organization. So why executive management form they're like the front liner of ERM, the board has to know, okay, to what extent is this ERM program put in place effective enough? Can we adjust it? So it's part of the board's role to do that. Review the entity's portfolio risks and consider it against its risk appetite. The board has to, this is our risk portfolio, and they benchmark it against the risk appetite. Are we going overboard? Are we within our risk appetite? This is part of the role of the board in risk oversight. Fourthly, they have to make sure that the management are responding to significant risks. It is not enough to identify your risks. That is just the first step. You cannot just identify your risks only. You have to respond, you have to manage, you have to analyze. So the board has to make sure that the management are not just only identifying and reporting risks, they are also managing it effectively. So that is part of the role of the board in risk management. So I'll also talk about risk reporting. We've talked about the role of the board in risk oversight. So now let's look at risk reporting. This is where the management has to report to the board. There has to be an interaction between the board and the executive management when it comes to risk management. One of the things that the board will be looking out for in risk reporting, there has to be the enterprise risk map, the top 10 risks, the emerging risks, and the current market outlook. These are like an outlook of what the risk reporting should look like to a board. Let me give, for example, let's say in the health sector, and they have a top 5 risks. Let me use the top 5 risks. Let's say first they have cyber security, they have clinical quality, they have, let's say, they have vendor management risks. So all these risks now, it is the duty, because the risk portfolio across the business unit will be a lot. It is the duty of the independent compliance and risk manager, the executive managers, to identify the top 10 risks or the top risks that are crucial to the company and present it to the board. Also, they have to do an enterprise risk map. This risk map is a data visualization tool. It's communicating specific risks that the organization faces. By this risk map, you'll be able to see, okay, these are the likelihood of my risks, the risks occurring, and these are the impacts. So these assessments will be shown to the board in an enterprise risk map. Also, we talk about emerging risks. The world it's a global village now, especially with the use of technology. So you cannot just stay within your own organization and the risks. You have to consider the external risks. Emerging risks could be, right now, one of the top risks they're looking at is cybersecurity. Before now, not many organizations were buying into the idea of working from home. So now we are doing more of working from home. There's a lot of technology involved. What are the cybersecurity? So there's an increasing need for companies to say, okay, the emerging risks are one, cybersecurity. So this is more like a global risk. Now we're having the virus in pandemic. It could happen anytime again. We have also climate changes, unfavorable weather. So the board should be aware, okay, in the global village, what is going on? What are the emerging risks? So it is important that the risk reporting capture this. Also, your current market outlook. Current market outlook are based on past performance, prevailing economic factors, consumer demands, and opinions. Let me take, for example, you have your interest rates, your inflation rate. The board should know, okay, this is what is happening in the current market outlook. Like now for Nigeria, there's been an increase in inflation, currently at 13.7%. The currency exchange rate has also increased. So the board should be aware. In risk reporting to the board, they should have this outlook of risks. So it is important that management present this to the board. So, okay, now for this, in risk management, we've talked about risks, We're talking now about board risk oversight and executive management as a defense in managing risk. There are about 5 defense lines in managing risk. The first one, so I'll just give you a brief of it. The first one is the tone of the organization. This is more like the foundation, the risk culture of the organization. The second one, we have process owners, business units. These are the people that implement the risk policies, the risks that you have put in place. So they have to be held accountable. So this is where your the second line of defense is. The third line, you have independent compliance function and risks. Most of the time, some companies, it is being driven by the CRO, the chief risk officer. So they are the ones that set up the policy. They are the ones in charge of putting the ERM programs. They do that. Then we have the fourth line of defense, which is internal audits. What internal audit does from time to time is to review. They review these policies, they review this program that you've put in place, standard of procedures. It's okay. What could be better? What are we not doing well? So this is where internal audits comes in at the fourth line. Now for the fifth line, which to me I feel is the bedrock in managing risk, is the board and the executive management. What does the executive management do? They are in charge of initiating the proper tone of driving, and everyone is responsible risks. Everyone is responsible for risks in an organization. So they are the ones that make sure each defense line are operating functionally and effectively. They're doing the best. So it's the executive managers that drive this. The board of directors, what do? They interact with the executive. Interaction to get insight into risks and ensure that nothing is constraining this defense line, that each defense line is able to report its risks and in a timely manner. The end of all this, the end of what we want to achieve in this risk management is decision making. Board of directors want to make quality decisions. Should we make, should we buy, should we diversify or not? Where is where risk management comes in? You want to make quality decisions. So the board and the executive have defense lines in risk management. So now I'm going to tell you that as the board and the executive management, they form part of the defense line in risk management, there are also threats. This is like risks to this defense line. One of the risks is that the management does not involve the board of directors in a timely manner of the strategic issues and important policies. So if the board, if the management is not involving the board of directors in a timely manner of what is going on, this is a threat. Early detection of risks is important. Reporting and finding a solution to it is important. A snitch in time, you can save a lot by reporting and doing things in a timely manner. So there will be a threat to this defense if the management is not involving the board at a timely manner. So secondly, there's a tolerance for conflict of interest in execution of significant business risks. So let me give you an example. If company A has about 4 product line and product A happens to be more profitable, it is very risky that it's possible that the board of directors of the management, they turn a blind eye towards the risks that is associated to product A. Because it is profitable, or we're just getting money from this product line, they turn a blind eye to this. So there's a lot of tolerance. Okay, we can go over our risk appetite, we can manage through, we can violate that law just because it's giving them money and it's profitable. So these are threats to the defense line. Also, executing the same strategy and model. With the COVID-19 pandemic that has recently occurred, it is absolutely necessary that all companies should review its strategy. You can't continue to work on the same business model. Some companies have done well, they've reviewed their budget. They've also tried to say, okay, for survival of this business, should we continue in this line? Do we need to diversify? So you cannot continue to execute the same strategy over time. You need to review your process, and you need to make sure that what you are doing and your assumptions, they are valid enough. They are valid enough. So the fourth one is unremedied significant control deficiencies and unaddressed compliance violations. I've talked about the defense line, internal audit, business process owners, business unit and process owners, and the independent risk and compliance functions. What they will do over time is to report this. They will be letting the management know that, okay, we are having significant control deficiencies in this area. We are not complying in this. If the executive management and the board do not address this, they just keep carrying over and over. So what is now the essence of risk management? So these are threats to the defense line. Okay, I'm going to be wrapping up with this. This is the principles for risk management. Principles for risk management risk management program in an organization. So if you want to put in place an ERM program, what are the principles you should look at? So the first one is integration. I like to take integration and inclusive together. So you have to make sure that your risk management process cuts across all units. They are not just focusing on finance, they're focusing on all units, sales, procurement, security. It is inclusive. It is more holistic because it's an enterprise. You have to make sure that it is inclusive and integrates all units and departments. The second one I'll talk about is structured and comprehensive. You want to have an ERM program that is structured because you want to have desirable, consistent results, desirable, consistent outcomes. So you have to structure your ERM program. The third one is to customize it. There are different and various industries. You have to make it your own. Bring it down home. Your ERM program should be customized to meet your own need. It's not just a generic thing. To meet your own need, you should meet your own industry. Then also, we talk about our peak dynamic and practices continual improvement. ERM program should not be static. It is open to changes, and there should be constant review. You have to constantly review that what my ERM program organization is effective and it's what is obtainable. It is still valid. So you have to continually improve that. Then I'll look at uses best available information, risk management, reliable information, both past and then forecasted information. You have to make sure that you are using the best available information so that you can respond to your risks appropriately. Then you have to consider human and cultural factors. If I'll go back to the first case study, which was Wells Fargo, if the company had a right tone in risk management, the right risk culture, its employees wouldn't have engaged in such. If your company drives a risk culture approach, you hear employees say, this is not our standard. This is not the quality of material we use. This is not how it should be. So you have to drive that culture. You need individuals to drive this risk culture. So you have to consider and drive home a risk culture in your ERM program. So, okay. So this is it. I want to say a very big thank you. I'm going to end with this quote set. There's no discovery without risks. And what you risk reveal is what you value. I think. Thank you very much. Thank you.
Okay, wow. That was power packed. Thank you so much, Mrs. Joy, pardon me. Thanks for the enlightenment. Thanks for sharing with us. Oh, can you hear me? What's going on now? Hello?
Yes, I can hear you. Right.
I can hear you.
All right. Thank you so much. I believe we all have questions. I believe we all took down our major points. And for any question you have, just drop it up on the chat. And Joy is here to smash it, to give answers to every question, everything that is blur, everything that is not clear. Oh, I need to know how to do this. I need to know how to do that. All those risks, effects of risks that was listed out. I need to know how exactly to curb them. Just drop your questions and it will be very, very, very well attended to. I picked up something that was said. She said risk management is for everybody in the organization. Risk management is for everybody in the organization, not just from top management down the management line. So it's our responsibility, it's your responsibility, and this is okay. Okay. Someone is asking if we can get your slides. You want to have all the pictures and all the presentation. She's smiling. Can we get your slides, please?
Yes, definitely. You can. I'll speak to the organizers and find a way to get it across.
Oh, wow, so generous. Mm. So after the program, we can also be with the program anywhere we find ourselves. Okay, thank you so very much. Any other question, please do well to drop it on the chat. It will be attended to. It will be attended to. Uh, this is 1/4. We had the first segment cleared out. We'll still entertain as many questions as possible on the topic board perspective on enterprise risk management, ERM. Okay, and someone is asking if ERM is different from risk assessment. I would like to know, that is from Christopher Uchenna. I would like to know if enterprise risk management is different from risk assessment. Over to you, Ms. Joy.
Um, okay, it's just like the person took out a, a sector from a whole view. So ERM, it's a holistic view. Risk assessment is part of what enterprise risk management will do. So I hope I've been able to answer your question.
Okay. So risk assessment is like the meat in the pot of soup.
Exactly.
Oh wow. Okay, that is for Christopher. I think we've done justice to that. There's another question that says, how do we ensure enterprise risk management is in sync across the organization? There's usually a disconnect between board of directors and ground level staff. This is from Faye. How can we ensure enterprise risk management is in sync across the organization? There's usually a disconnect between the board of directors and ground level staff.
Okay, if you listen to me very well, I said the board and the executive management, they form the fifth line of defense. And part of the threat to this defense is when the two of them are not in sync. Maybe the management overrides the board decision. So what she has spotted out is that this is a threat. It happens in organizations, the management and the board, but it shouldn't be so. This is a threat and this is a failure already in risk management. It is the executive management, their duty to champion the risk management mantra in the organization across different business units and process owners. So it is more of their duty. If there is already a disconnect between the board and the executive, I must say there's already a risk management failure in that organization.
Okay, so it's an entity and they have to be synchronous. Everybody has to work hand in hand.
Exactly.
There should not be gaps. Okay. Well, we make progress. Please keep your questions coming up. We'll also try our best to make sure they are all attended to. I must appreciate every one of us for following up, for listening, and it's knowledge. We're helping ourselves and we're making this a success. Thank you so much, ma'am.
Thank
Joy,
you
we are
too.
so happy to be enlightened in this line.
Thank you.
Okay, we can keep the messages coming in. I will just um give us a briefing on our progress so far. This is the first edition of the 2020 Annual Risk Managers Congress, and successfully we've had the first topic being handled by Ms. Joy Usoekan, pardon me, and
No
it was
problem.
purely on board perspective on enterprise risk management. We are still giving room for questions and answers. Our speaker is still up, but simultaneously we are getting ready for the next speaker, which is Feyi Togan. Feyi Togan has 7 years experience in GRC governance, risk management, and compliance. He has a first degree in accounting from Covenant University and a second degree in risk management from the University of Lagos. He's a chartered accountant and a member of the System Controls and Compliance Group of Imperial Homes Mortgage Bank. Now he'll be talking to us on fraud risk assessment. But before he comes on board, I think, okay, there's still one more question for Miss Joy. Okay, let us just attend to Mr. Hakim Badmus before we bring up our second speaker. So he's saying, Joy, can we liken lines of defense to leaders and managers of the organization? Can we liken lines of defense to leaders and managers of the organization? Please, can we get Joy?
Please, can you come again with that?
Okay, this is from Hacking Badmus. He said, can we liken lines of defense to leaders and managers of the organization?
Okay.
Lines of defense, can we liken them to leaders and managers of the organization?
Okay. If you listen to me, I talk about the second lines of defense, which is process owners. So when you talk about process owners, they are the ones in charge of implementing this risk. Okay, you can see me now, right? they're the ones in the second line of defense is the business unit and process owners. So this is where the managers fall in place. They are the ones in charge of implementing the risk policies that have been put in place. So your managers and the leadership fall under here. Of course, the executive management are also leaders, and the board of directors and all, they're also managers, but the process owners are the ones that drive risk management. So it falls under the second line of defense. So yes, it's right. Leadership can align with the line of defense of risk management. So I hope I've been able to answer your question.
Okay, I'm sure that's very satisfactory to Mr. Hakim Badmus. I'm sure you're okay with that. For those asking for the slides, I think we are all we have access to the link via WhatsApp. So that will be sorted out once there's a consensus with the anchor, the host of this program. I gave a brief introduction of our second speaker. I can see his glasses and he's ready to bring out every fraud. Okay, that's by the way. Up next is Feyi Togan. Like I said earlier, he'll be speaking on for the next for the next 40-50 minutes. He'll be speaking on fraud risk assessment. Again, take your pen and your paper, take your notes. Joy kept saying, if you listened to me, I hope Mr. Feyi's testimony is not going to be the same. So over to you, sir. We're up for your lectures on fraud.
Thank you very much. I really do appreciate Please, can you confirm if you can see my slide?
Still sharing. Yep, it's
Okay.
up.
It's up. All right, thank you very much. I'm really grateful for this opportunity. Appreciate Seed Stars for this opportunity. It's a good initiative, and I think that this is just the best of many more to come. So, good evening, everyone. My name is Feyi Togan. Princess has already done justice to my introduction, so let me go straight into it. So, basically, today we're going to be talking on fraud risk assessment. Fraud risk assessment. Okay, just a minute, please. All righty. So, I'm going to be talking on fraud risk assessment. We're going to be looking at the concept of fraud risk, and at the end of the day, we're going to be looking at fraud risk assessment. Joy had already done some justice to fraud. She gave us instances of some companies in America, Enron, Wells Fargo, and these are popular organizations where fraud had done serious damage to the organization. Fraud is like a hurricane. People don't know how to, these events happen, they don't happen, they're not your everyday events. They happen once in a while, and people don't really pay attention to it until it happens. I don't know if you're following me. That's when people now start asking, where is the auditor? Where is the risk manager? Where is the internal control person? Where is the process owner? How did this happen? That's when people start running helter-skelter when a fraud happens. But what we're going to be discussing today is the concept of fraud risk, and how we can stay on guard such that we are prepared in the event of a fraud. And if a fraud does happen, how can we react? I specifically chose this picture because today we are going to be security guards, we are going to be police officers, not SARS people. We are going to be proper police people. And today we are going to dissect fraud risk assessment. All right, let's go into it. So we're going to be looking at the first is a 4-module program. So we're going to be looking at introduction to fraud. What is a fraud? What is the fraud triangle? What are the elements in the fraud triangle? So there are certain concepts that must be in place for a fraud to occur. That's where we're going to tackle elements in fraud triangle. Then we're going to move to fraud risk. What are fraud risks? Factors that influence fraud risk. Then we'll move into fraud risk assessment proper. What is the necessity of a fraud risk assessment? Why should I do a fraud risk assessment? These are questions that management, senior management, board of directors are going to ask you as risk managers, because this is not their day-to-day. You are the owner of this concept, and it's for you to sell it to them. So we're going to look at the necessity of a fraud risk assessment. We're going to look at the steps to formulate a fraud risk assessment. Then we're going to look at post-fraud risk assessment. We're going to look at fraud risk assessment guidelines, keys to a successful fraud risk assessment. So I'm going to trade to the house. Let me go back. Please use the chat box and let me know from the top of your head, what do you understand by fraud? What is a fraud? Hello, everyone. I'm waiting for responses before I proceed. Are we there? Okay, Adeyemi says unlawful gains. All right. Miriam says dishonesty. All right. Let's get more. Let's get more. Okay. And an intentional act to benefit self. Wow. Kingsley says fraud is characterized by deceit and illegal concealment, conversion of assets. You know the control people in the house. Yusuf says fraud is a deliberate act by a perpetrator to gain something of personal gain through falsification or deceit. That's wonderful. Deprivation of someone's assets, intentional act to defraud, falsification of figures for personal interest. You guys are bomb. You guys are on point. Let's go right into it. Let's go right into it. The suggestions so far have been excellent. There's a particular word there that I'm going to pick out, and it's key when you're defining fraud. Taking advantage of the loopholes in a system for self-interest, misappropriation of funds. Beautiful. All right, let's go. Okay, so by the end of this training, we're going to understand the concept of fraud, understand the three elements of the fraud triangle, understand the steps in conducting a fraud risk assessment, and know the reason and benefits of a fraud risk assessment. All right. So now, meaning of fraud. I picked 3 definitions from Investopedia, from Durham Police, and from the Association of Certified Fraud Examiners. Investopedia says fraud is an intentionally deceptive action designed to provide the perpetrator with an unlawful gain or to deny a right to a victim. Durham Police, Durham is a city in the UK, says that fraud is defined as a criminal deception committed by a person who acts in a false and deceitful way. Association of Certified Fraud Examiners. This is the association for fraud examination. If you have interest in fraud analysis, fraud examination, this is the association, like ICANN to accountant. Association of Certified Fraud Examiners is the institute that does this. They define fraud as fraud includes any intentional or deliberate act to deprive another of property or money by guile. Guile is being cunning, being funny, deception, or other unfair means. So what I'm going to pick here is that fraud is intentional. You cannot do fraud by mistake. You cannot do fraud by I'm not aware. Fraud is intentional. It's not by fluke. It's not by error. There is an intention to commit that action in order to deprive the organization, a victim, a person of their property, be it money, be it anything. And also, fraud is also an inaction. So this is what I mean by inaction. So as an internal auditor in an organization, maybe there's a particular process that I'm supposed to do. I'm supposed to review posted transactions from the day before. But because I'm in on it with the operations guy for us to commit a fraud, so my inaction, my not reviewing that particular document, so that maybe later I can say, but I did not review it, is also a fraud. It's also a fraud. Thank you very much for the responses. You guys were spot on. Please note that fraud is intentional. It is key. Fraud is intentional. So let's go to the next slide. All right. So fraud is intentional and errors are accidental. Now, I want to ask a question. I want to throw a question out. So you walk into Guarantee Trust Bank, First Bank, one of these commercial banks, and you want to deposit money into your account, and you give the teller, the posting officer, you give him 5,000 naira cash, and he ends up crediting your account with 6,000, which is 1,000 higher than the amount of money you brought in initially. So that is an error. That is not a fraud. Also, we have situations whereby the operating system can have issues. You have situations whereby you're trying to transfer money to someone, or someone is trying to transfer money to you, and upon transfer, you get a double credit into your account. So in that situation, it's an error, a mistake. It's not yet a fraud. Where it becomes a fraud is when you immediately transfer that money out of your account into another account, so that before they catch me, I'm a sharp guy. No, there's a difference between a fraud and an error. So we have errors and we have fraud. Errors are accidental, fraud is intentional. So in order to detect and investigate fraud, one must understand the reason people commit fraud. This brings us to a very, very, very key concept in fraud, which is the fraud triangle. Now, there are three elements in the fraud triangle. So we have motive and pressure. This is where the fraud triangle starts from. In the slide, you can see personal financial pressure, addiction. So pressure is just like the economic situation right now. The inflation rate for food is at, I think, 13.5%. Food is very expensive now. Food stuff is very, very, very expensive right now. So, and of course, inflation and salary, they are not friends. As inflation or cost of living is going up, salary is either stagnant or depleting. Because of the coronavirus we had earlier in the year, a lot of people lost their jobs, and so the economic climate right now is very, 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 very weak. People are not buoyant, so there's a lot of pressure. Even people that still have their job, there's a lot of pressure to meet up with cost of living. So naturally, people are under some sort of pressure. Well, okay, fine. Salary is not enough. I'll do side hustle. There are different ways for you to manage this pressure. But if it becomes, if one does not keep it under threshold, that's where it becomes a problem. Being under pressure is not a challenge. That's where people get the strength to, do more, get a promotion at job, put in more work, and you get the benefits for it. But where pressure is not manageable, that's where the problem is. Then comes rationalization. A lot of people, they feel that they deserve more. So you hear stuff like, I haven't received a raise. These people, they don't consider me. People start rationalizing their effort and reward. Now, from my experience in the business environment, one of the times to check rationalization is when promotion list is released, because that's when rationalization is at its peak. Because pre-appraisal, people already have these high hopes that when the results come out, I expect this. Some people have even gone ahead and start planning against their expected promotion or bonus. And when the results come out and it's not the case, they feel downcast, they feel down, they feel weak. So this period is very, very, very volatile. As control people, we need to keep our antennas up, because this is usually the period where people, they want to take one back at the system. They want to take it by force. They want to, try and take advantage of the system and commit a fraud. So we have motive, we have pressure, and we have rationalization. Then all of this is still not enough to commit a fraud. Then you have opportunity. Opportunity is the third and key element. It's very, very important in the fraud triangle. It's like all these movies where people want to break out of jail. They have the plan, they have all that in their head. Opportunity is when, in all these movies, when the warden is sleeping, or they've tracked how everyone is clockwork, they know how everything works. And opportunity is usually that period where they know that if we hit it, we'll get out of this jail. So here we have lack or end around of internal controls, senior management not paying attention. So basically, opportunity is usually when there's a lapse in control, and the perpetrator knows this and takes advantage of it. So for the fraud triangle, two of the elements are, it's the fraudster that is in control of these elements. That's motive, that's pressure and rationalization. Where we as control people come in is opportunity. We always have to make sure that there is no opportunity for fraud as much as possible. We always have to go back and review controls to be sure that there is no loophole that will give an opportunity for a fraud to occur. This concept is very, very key. It's very, very key. I'm sure you can all relate. All right, so we'll proceed. What is fraud risk? So basically, risk is the probability of an occurrence, usually a negative occurrence. Fraud, like we discussed earlier, is an intentional act to deceive or convert or take undue advantage of someone or an organization for personal gain. So there's fraud risk. Fraud risk can be defined as the vulnerability that an organization faces from individuals capable of combining all three elements of the fraud triangle that we just discussed: pressure, rationalization, opportunity. The vulnerability that an organization faces from individuals capable of combining all three elements of fraud triangle. That's one of the reasons why segregation of duty is very, very key. You don't want an individual posting, approving transactions, because he can on his desk, can commit a fraud. And in internal audits, we say that we trust God, every other thing we verify. So let's move on. Fraud risk can come from sources both internal and external to the organization. So yes, staff in the organization can commit fraud. And also we have external, that's where you have hacking, you have people trying to break into your system and trying to do the unthinkable. Risks that are present before management action can be described as inherent risk. So, for instance, shit in the Niger Delta region, fluctuation in oil prices, those are risks, those are inherent risks. Then the risks that remain after management action can be described as residual risks. That's after you put in internal controls. But even after you put in internal controls, there might still be some risk even after that. For instance, in the mortgage industry, where we give facilities to customers to buy their own properties and all that, at the end of the day, there's still credit risk. You can never guarantee that an individual or a company is going to pay you back. So you do your risk assessment, you do your analysis and all that, but there's still residual risk of default. That's what residual risk is talking about. Then the aim as risk managers is that we make residual risk significantly lower than inherent risk. Residual risk must be within the risk threshold of the organization. All right, proceed. Factors that influence fraud risk. Nature of the business. So factors that influence fraud risk is not straight line. Different organizations have their susceptibility to fraud risk. Different organizations have different factors that affect them. You cannot compare a Jumia or a Konga or an Alibaba. The fraud risk that they are susceptible to is not the same as Shell, not the same as GT Bank. The business environment influences the fraud risk. The environment in which the organization operates effectiveness of its internal controls. How strong are your internal controls? How in depth are they? How of what quality are they? Are they strong enough to mitigate the crystallization of fraud risk? Then the ethics and values of the company and its employees. So I'm going to throw a question out for us to respond to in the chat room. So the Nigerian public sector, the ethics and values in the Nigerian public sector, is it strong enough to deter fraud risk compared to a private sector company? So public sector in Nigeria and private sector, the ethics and values, generally, the perception of fraud, of deception to gain in a deceitful way. Who public sector, private sector, basically. Let me check. Do you think the Nigerian public sector gives you the perception that the ethics and values are strong enough to deter fraud? Can you share your screen? Okay, I see a question here. Please, can you share your screen on the aspect that speaks on management focused inherent? Okay, Olu Yomade, I'll come back to that. I think I'll proceed. But basically, what I was trying to address there is that the Nigerian public sector does not give us that perception. So basically, you have people going into public sector and they have it in their mind to go and chop money. You know, that's a wrong tone at all. Perception is poor. The ethics and values of the public sector in Nigeria is not strong. It doesn't give you that vibe of that strong internal controls are in place in the Nigerian public sector compared to the private sector where the ethics and values are stronger. The corporate governance in the private sector in Nigeria is way stronger compared to the public sector. Although we have institutions that are supposed to enhance the ethics and values in this sector. Okay, so Kingsley says the ethics and values in the Nigerian public sector lacks the strong tone at the top to deter fraud because there are no punitive measures for public servants. That's absolutely correct. Because and all these things they Hello, can you hear me?
Yes, please go ahead.
All right. So I want to share. Please, can you see my screen?
Yes.
Okay. So my sincere apologies. I'm having network issues on my laptop, so I'm going to be using my phone to continue this presentation. Host, please, can you confirm what slide you can see?
What is fraud risk?
All right, thank you very much. So just before that interruption, Mr. Lucas had given us an insight on some of the issues why the public perception is poor, because the private sector reports to the board of directors, and our public officers work with impunity. Like, what is the consequences if I commit a fraud? What's going to happen? And that's wrong. That's wrong. That has a way of rubbing off on other sectors of the economy. And like I said, it discourages foreign direct investment. It discourages people bringing in their money from abroad because they won't understand how. I don't understand. It's difficult. It's difficult to comprehend. All right, so let's move on quickly. So we've come to fraud risk assessment proper. Now, it's not enough to understand the concepts of fraud. It's not enough to just understand fraud risk, because as risk managers, how we can help our organization strengthen internal controls to mitigate to the barest minimum the crystallization of a fraud risk is a fraud risk assessment, a comprehensive fraud risk assessment. So there are definitions here, and I'll run through them. A fraud risk assessment is a tool used by management to identify and understand risk to its business and weaknesses in controls that prevent a fraud risk to the organization. Keyword, a tool to identify and understand risk, a fraud risk. I'll move ahead. Fraud risk assessment can also be described as a process aimed to proactively identify and address an organization's vulnerabilities to internal and external fraud. Like I said, the fraud risk assessment is a mechanism, is a tool that helps to identify, understand risk. And these risks are the fraud risks that we had highlighted earlier. The business environment, factors that one would consider to identify a fraud risk. When you identify this fraud risk, the risk assessment will help you identify, understand, and address these vulnerabilities, both internal and external. We move on. Why should organizations conduct fraud risk assessments? Earlier, I said that as a risk manager, you engage senior management, you engage the board of directors. There are fraud risks out there. Although fraud don't happen every day, but when they happen, it's like a hurricane. Everybody is running helter skelter. Fraud was so serious in the case of Enron that they had to, the United States Senate had to come up with the Sarbanes-Oxley Act in 2002. It was because of Enron fraud that the concept of corporate governance became very popular. So although it doesn't happen every day, but once it happens, it's a big deal. So of course we have to engage board of directors, we have to engage senior management. And these are the reasons why we need to do a fraud risk assessment. One, to improve communication and awareness about fraud. Secondly, identify what activities are the most vulnerable to fraud. Know who puts the organization at the greatest risk. Develop plans to mitigate fraud risk. Develop techniques to determine if fraud has occurred in high-risk areas. Because it's possible that while we are here discussing, a fraud might be occurring in our organization. So until you carry out a comprehensive fraud risk assessment, you may not know. You may not be in the know. It's not magic. You're not a witch or a wizard to know that, okay, they are doing fraud in the inventory occurring in sales. It's fraud risk assessment that helps us, that shines the light towards this area. Fraud risk assessment also helps us assess internal controls, and it helps us comply with regulations and professional standards. Thank you. So let's move on. Now, how to conduct a fraud risk assessment. So I'm going to expand this a bit, and I'm going to talk on each and every one of them. So there are 7 steps here on how to conduct a fraud risk assessment, and I'll be talking on each on one of them briefly. Time is not aside, so we'll move on very, very, very swiftly. Thank you very much so far. I'm really, really enjoying your company. I wish I could see your faces and, engage you more, but we proceed. These times we have to adapt. E is the way forward. So let's move on. So the very first step in conducting a fraud risk assessment, number 1, is to plan. You build your fraud prevention team and set your goals. So the fraud risk assessment is not going to be done by only the risk manager. No, it's an enterprise-wide activity. Doesn't mean that every staff in the organization is going to be actively involved, but we have to bring in some people on board. So first, we want to bring people from senior management, heads of units, group heads. Specifically, you want someone from legal, because usually when a fraud occurs, the best, or usually the one of the most routes in handling fraud cases is usually the legal way, because it depends on the kind of fraud the perpetrator might, it usually goes down the legal way. So we want someone from your legal team to be on board, because there might be some certain aspects of the law that you may need to consider when doing your fraud risk assessment. You want someone from HR to be on your team. Of course, you, the risk manager, of course, you're there. You want someone from the internal audit, internal control unit to be there. You get. And also, it is important to consider the factors that influence the fraud risk that we mentioned earlier. Also, in this aspect, nature of business environment, effectiveness of internal control, the organization's value and ethics. All of this will help in the planning stage. So secondly, we move to identify, establish the risk your organization faces. Like I said, no 2 organizations is the same. No 2 industry is the same. Even though MTN and Airtel are in the same industry, the risks they face differ. MTN and Glo, yes, they're in the same industry. The risks they face differ. MTN might be doing capital flights to South Africa. They'll definitely consider exchange rate risk fluctuations. Glo may not need to do that, because Glo is an indigenous organization. So it's not a copy and paste process. It's something that must be done fresh. And of course, there are different ways to identify the risk. You want to do interviews, you want to go observation routes, you want to give out questionnaires. And something I need to mention is that identification, this part is enterprise-wide, like I said. So it's not something you do in isolation of the whole bank. Everybody needs to know that, yes, we're coming up with a fraud risk assessment. This is what we want to do. So it's not a case of we're not hiding to do this. Everybody is involved. Everybody's input is involved, because we have, for instance, now in an organization where, let me say, an organization where they are key on ground staff, people on the front line, an organization whereby they send people into the market, people into the society to market the organization or sell goods. stuff like that. Those people might help you with key information that you in the office may not know because they are the ones on the field. So these are stuff we need to consider in identification. Identify those risks that are pertinent to the organization. Then thirdly, assess, evaluate the potential damage risk could cause. Now, in this aspect is very, very, very important because after identifying those risks, we need to assess them. We need to check their weight, high, medium, low. How often is the occurrence, likelihood, upon occurrence, how significant is the impact? We need to consider the loss. We need to consider financial, reputational risk. That if this particular risk crystallizes, what's the loss to us? And of course, it has to be weighted. You need to consider the effort you're putting into it plus the reward. We don't want to spend too much resources on a risk that is not as significant as another. And one of the key concepts to help in assessment is a risk matrix that shows that compares likelihood and severance. So we'll move on to prioritize. Prioritize is you coming up with a plan of action. We've identified the risks, we've assessed the risks, so we need to prioritize the risks. We need to allocate resources towards significant risk, such that the organization is well equipped towards these risks that have been identified. Then we'll move to communicate. So, fine, we've planned, we've identified, we've assessed, we've prioritized. So we need to come up with a report of our findings across the organization. Come up with key focuses and deficiencies, because by the time we are at stage 5 already, you should already have an idea of the areas, of the units, of the departments that are most susceptible to fraud already. Even at prioritize, it's even possible that you may even spot a fraud in this process, because maybe that unit or that process, that procedure has been ignored for so long. So upon assessment, upon prioritizing, we just notice that, wow, can you imagine? We don't do stock count. And of course, in FMCGs, in fast-moving consumer goods industry, stock is very, very, very important. Imagine not doing stock count in an organization like Indomie. It's a recipe for disaster. Or not prioritizing the admin inventory department. So at Communicate, we compile our reports, we include our action plan, we discuss with staff, with timelines. So at Communicate, it's not just to pile up the report and send it upstairs to senior management and the board. No, we also need to engage, because for some of the action plans we need to take, all may not sit at the desk of the risk manager. You might need help from some other units, maybe IT, internal audit. It depends. You might also need inputs from some process owners, because they might have a role to play. So you want to determine the timeline for resolution and all that. And also at this point, it's ideal to develop a fraud policy. And of course, this fraud risk assessment does not just stop our employees. You also have to consider your contractors, your suppliers, basically your stakeholders in general, because a fraud, like we discussed earlier, can be internal and external. Then we'll move to implement. Put in place your procedures and controls. So the controls, of course, you've communicated, and so it's time to implement. It's time to put all this paper into action. So, of course, the controls can be preventive, detective, or corrective. So by preventive controls, these are controls that are aimed to stop or prevent the occurrence of a fraud. Trainings, audits, These are examples of preventive controls that can help to prevent the occurrence of a fraud. And have detective controls. These are controls that are put in place to uncover a fraud, stop counts, investigation, whistleblowing hotlines. These are key. These are key procedures to put in place. Whistleblowing is very key. It's been said, statistics from ACFE, Association of Certified Fraud Examiners, says that 60% of frauds that have been uncovered is from whistleblowing. You cannot do it yourself. You need help. There are people on ground. There are people that are involved in this process every day. The process owners are more involved than yourself. So you cannot sit at your desk and, you need to encourage whistleblowing. People should be able to come up to you as the risk manager, as the internal auditor, and talk to you that, excuse me, sir, excuse me, ma, I think that there's a problem here. I think you should look into this area. Then, of course, we have corrective controls. The fraud has happened, so we need to put in controls to prevent a reoccurrence. That's basically what corrective controls are there to address. Then we have monitor. So monitor, track the measures you've implemented and report on your progress. So basically what monitor here does is we need to have a continuous improvement mindset. We need to ensure that we shouldn't go to bed. Yeah, fine, we've planned, we've identified, we've assessed, we've prioritized, we've communicated, we've implemented, but we can't go to sleep. We need to continue monitoring these processes. For instance, now, I can bet you that a lot of organizations, their risk forecast for 2020 in January is not the same today. A lot of activities have happened this year that you need to, if you're not monitoring, you're sleeping on a bike. You need to constantly go back and check, because the fraud risk you're exposed to in July is not the same fraud risk you're exposed to in October. It may not be the same in December. So the need to monitor cannot be overemphasized. You can think that you're on top of your game today, but the business environment is changing like, I don't even know what to say. So we proceed. So we move quickly into fraud risk assessment guidelines. So the assessment should be performed or updated periodically due to changes in internal processes and controls, organizational structures, segregation of duties among various personnel. So of course, let me quickly speak on, I think the rest are self-explanatory, but let me quickly speak on organizational structure. So the organization might open a new branch in a new location. Maybe generally in the industry, this area is, it depends, but the organizational structure might change, and the new locale for a branch or a new department might necessitate attention, a need for the risk manager, risk management unit for control staff, to pay more attention to that unit, pay more attention to that branch in that region. Of course, the fraud assessment should also address asset misappropriation, financial and non-financial reporting, regulatory compliance areas, and illegal acts. And also, one of the things I want to mention is that there should be a sanction grid in place such that if a fraud occurs, there are penalties that are stipulated for, depending on the fraud, but there should be a sanction grid, and this should be communicated to all staff such that nothing is done. People know that there is punishment for misbehavior. Just like Mr. Lucas had mentioned earlier, that the reason why some of our the public sector, they act the way they act is because they know that they can get away with it. So we in our organization need to ensure that people don't get that idea, they don't get that notion. You can't get away with it. If you misbehave, you will be penalized. So what it takes to have a successful risk assessment. This assessment is just one tool to use in developing a comprehensive approach to managing fraud risk, which should also include the development of a fraud risk policy as part of organizational governance. This is key. The development of preventive and detective fraud control activities, a fraud reporting process, whistleblower policy, we had mentioned that earlier, and a coordinated approach to investigation and corrective action. So a coordinated approach to investigation and corrective action means that if a fraud does occur, you don't want to look surprised or confused that, hey, what has happened? No, you already know your team. Once there's a need for an investigation, fine, a fraud has occurred. There's been a weakness in control and someone has taken advantage of it. Sharply, you pull together your team and immediately you go on to investigate immediately. And another thing that makes for successful investigation is time bound. The faster you are able to identify the root cause, the better, so that you can nip it at the bud. So, in conclusion, fraud is a risk and must be continuously monitored to reduce the probability of occurrence. Fraud risk assessment will increase awareness in the organization, promote effective resource allocation, and prepare the organization in the event of a fraud. Promote effective resource allocation. So when you do your fraud risk assessment, management knows what and what to buy. There are also computer assisted tools that help some of this fraud risk assessment, because for instance, there's this fraud back in the days called salami technique, where the individual will just be taking little amount of money from customers' accounts, maybe two kobo, 3 kobo, 1 naira, very insignificant that you won't notice. But the settlement account where it's going to, imagine taking 1 naira from all the customers in GT Bank or First Bank or whatever. You can imagine how much money such an individual is going to make away with. But as an individual, as a risk manager, as a control person, you may not be able to monitor this manually. You also need IT to help to do a scan or whatever the case may be. So fraud risk assessment also helps organizations with resource allocation. So thank you very much. Come to the end of my presentation. I hope you're able to learn one or two things in the aspect of fraud risk, a fraud triangle, fraud risk assessment, how to develop a fraud risk assessment, things to look out for, and also after the fraud risk assessment, things to pay attention to. Like I said earlier, monitor. Thank you very much.
Okay, wow, that was beautiful. Thank you so much, Faye.
Yeah, thank you. I
That
do
was really
appreciate.
loaded information and knowledge at its peak. Okay, fraud risk assessment, section 2, we're done.
Yeah, I do appreciate.
Would encourage everyone to drop in their questions. The package he has packaged for us. Assessment, we've gone through from fraud to assessment. Please do have to drop your questions in the chat. Everyone is enjoyed to drop their messages. Just drop your questions on chat and you will do justice to that. I'm 100% positive we are all together. I've been able to scale through 2 sections and I would gracefully hand over the baton to my co-moderator. There's no other person than Mary. Mary Kajagbe.
Well, thank you
She's
very
also a
much.
financial analyst. Over to you. Hello, can you hear me?
Yes, I can hear you, Princess. Can you hear me? Hello, Princess, can you hear me?
Yes, we can hear you.
Okay, thank you very much. Good evening, everyone. Thank you for joining us this evening. My name is Mary Kajagbe, as earlier introduced by my co-moderator. I want to once again welcome you all to the maiden edition of the Annual Risk Managers Congress as put together by SeedStars Consulting. I feel very delighted to be a part of this webinar tonight. And I believe that we have all added to our wealth of knowledge, particularly in areas of risk management and fraud risk assessment. I want to assure us that we still have a lot more to learn tonight, and I enjoin us to sit back and enjoy the rest of the sections. Many thanks to SeedStars Consulting and our very brilliant speakers, Joy Usokon and Faye Togan. Let's not forget to keep our mics and our video muted, and also to drop our questions in the comment section, if any. I want to welcome our next speaker, who's going to be talking with us for the next 40 minutes on risk and resilience innovation strategy. A beautifully coined out topic, you may say. Yeah. Our speaker has over 10 years experience in finance, audits, internal control, governance, human capital management, and risk management. He has a background in banking and finance. He's a member of the prestigious Institute of Chartered Accountants of Nigeria, ICANN. He's an erudite financial analyst with all the accounting standards, auditing standards in his fingertips. He's also a renowned risk manager and the brain box of First Choice Accurate ICANN Tuition House in Lagos. He's currently working with May and Baker Nigeria PLC as the risk assessment manager. Dear professional colleagues, let's make welcome Mr. Ayomi Ladokun. Over to you now.
Okay. Good evening, everyone. Can you confirm you can hear me?
Yes, I can hear you.
All right. Thank you. Thank you very much. I want to appreciate everybody here, and thank you for joining us for this program, and for our speakers. You've done really great. In fact, I'm not really too sure whether I want to, really glad because I've really, learned a lot here. It's been very fantastic. Thank you, Joy. Thank you, Faye. It was really loaded. So it really, put up a lot of background that is quite important for this segment. And to all our participants, thank you for staying tuned. So obviously, this is an initiative from Risk Intelligence Forum that was created about 2 years ago on WhatsApp, where we discuss about risk, about internal audit, internal control, governance. It's just an initiative, to really help us on how to improve on our job functions across industries. And this initiative just came about a few weeks ago that we can actually come together, to discuss much better. And the whole idea is, to also have a kind of family forum. And that's why we're having the first edition, that's 2020 Risk Managers Congress. And the title, obviously, or the focus is risk, innovation strategy, and corporate value. So if you see what we've been discussing since about 7 p.m. We've talked about broad perspective on enterprise risk, and of course, it's having a link to corporate values, and of course, fraud risk assessment is also very important. You can imagine what Joy told us around Heron, and companies that actually went down all because of fraud. And he also did a very insightful work around fraud risk assessment, and you could see that it's quite important for organization to really embrace risk management. But let's just move on because of time. Okay, obviously this was set up by Sisters Consulting in partnership with a risk intelligence forum that we have. Okay, it's just a professional service company that also provide a range of services. And of course, they told you a lot about me. So in case you probably are just joining. So my name is Ayo Miladokun. So let's move on. And of course, I'm sure we are aware of our training instructions. Just let's be muted on both video and audio so that we are not distracted, okay? So all your questions, obviously, is going to be attended to. So the topic we are going to try to look into is risk and resilient innovation strategy, okay? This was born out of, the changing, fast-changing business environment. You could see what happened during 2020, the COVID-19 pandemic, obviously ravaged the whole world. Around December 2019, if somebody is standing and telling us that would be a pandemic, that put the whole world on a standstill, then you begin to wonder how would that, happen. But of course, it happened, and you see so many companies are under the carpet as we speak, and of course, probably the companies that were able to, exist as we speak, maybe one way or the other, they have embraced risk management and a little bit of resilience around that, and of course, the whole idea, is to ensure organizational resilience, when it comes to innovation and of course our strategy. So this title or focus, I just sat in my office and I coined out this title and the focus for the Congress, so that we, as managers, as risk managers, as auditors, as a control person, even if we are within the operations, so we understand why we are really doing this. And don't forget, the whole essence is to ensure corporate sustainability and of course resilience. Okay, so that's the focus. And if you see those pictures there, they have meaning. I think the very first picture on my right hand side from here, you can see a nose mask. That's to tell us the season we are in. That's the COVID-19 pandemic. I heard some countries are experiencing the second wave of the pandemic. Okay, so you could see how devastating that could be. And the other picture is just telling us that it's quite important that we embrace risk so that we can ensure organizational resilience. And what is the real thing around innovation? Okay, so we're going to take a look. It's quite enormous, but I would take time to try to take a little time to explain so that we can cover as many as possible, and we move on. Okay, all right. So let me try to move on here. This is our training outline. I'm going to do some introduction. I will also revisit the meaning of risk because I'm sure we have some people here that might not really know what risk is. Probably you are not a control person. And what are the wrong assumptions about risk? We're going to find out what is innovation. And of course, difference between creativity and innovation, are they actually the same? We're going to find out sustaining versus disruptive innovation, innovation risk and limitation. We are going to see that, and strategy and value creation. Don't forget, you're also taking a look at corporate values, right? And obviously, we are going to take a look at real life scenarios. That's examples of companies that failed to innovate. I pretty like, the introduction Joy gave us earlier on. That was so fantastic. All right, so that's why I said she has really done a very good job. And the beauty thing was it's as if we had a discussion about, these presentations. I just call on them, ask them to choose, and they just choose, and they were able to come up with those brilliant slides. They are so powerful. And of course, we are going to also take a look at 5 rules to manage innovation risk, and of course, cases of resilient organizations. So as we are taking a look at those organizations that failed, we're also going to take a look at, some few organizations that were also resilient, so that we can learn, on both sides. And of course, we do some conclusion. So I believe at the end of, we have a lot, before us. And I want to believe at the end we will be greatly blessed, and obviously it's going to also impact positively on our job function. Okay, so let's start. These are a few of the training objectives. At the end, I expect our participants to understand how to build risk management into innovation strategy, so that we can ensure organizations resilience, and of course, risk that can impact innovation strategy. And also creativity and innovation, we will understand that, and why companies fail. My speakers have done justice to that, but it's also coming up here. And 5 rules to manage innovation risk. Okay, so and lots more. That is obviously, the objective. Now, so let's take a look at the introduction. Okay, effective business risk management is one of the key components of organizations' overall governance framework. Okay, like John said earlier, risk is not something that is new, that has been there. Maybe probably this part of the world, we've not really, embraced risk, unlike the European or the Western countries. Okay, but obviously, just because of COVID-19 and all of that, most organizations are now seeing the importance of risk. But the whole essence here is that, it's one of the key components of the overall governance framework. And managing risk continuously, my speakers have said it earlier on, is going to assist organization in setting strategy. There was an emphasis by one of the speakers that it's not enough to identify risk, you just have to monitor. And it's an ongoing process, right? So the fact that, like Kafi just said, he said, the risk that you face in January might not necessarily be, the kind of fraud risk you're going to face, around July or even in December, because of the, fast changing business environment. So when you try to manage risk continuously, okay, so it's going to help organization in setting strategy. You could also see a link from what Joy showed us, that risk is not moving from, mere operational risk, compliance, are we paying taxes and all of that, to strategy risk, right? Because those are the things that can actually affect corporate goals, objectives, and of course, corporate values, right? And taking risk is fundamental to being profitable. So as bad as risk may be, as it's true, it doesn't really mean we're not going to take risk, right? Okay, and because it's quite important that we take risk if we want to really deliver on strategy, because there's always a link between risk and return. Now, let me take a look at this. Innovation is risk. Don't forget, we are talking about risk and innovation strategy, right? Innovation is risk, and of course, growth is risk. Have you ever wondered, seeing some companies, the way they are growing? Okay, I've been at an interview. I'm not going to, okay, I'm not really sure whether I should not mention the name of the company. And, sometimes ago, and, after asking me so many questions, and they asked me if I have questions for them. And I said, yes, I do. I said, this company just, came on board around 5 or 7 years ago, but the rate of growth is quite alarming, okay? The way they open branches, the way they, locate their businesses across Africa and even beyond Africa within 5 years is. So I was asking them, do you guys really have, that capability or resources to support those growth? So that's to tell you that there is risk in growth, okay? The chief interviewer, or is the interviewer now, right? Okay, well, he just looked at me and said, wow, what a question. So that's the issue here. So if you are not growing, there's risk, right? And if you are static, there's risk. And if you are growing, there's also risk. So innovation itself is also risk. And avoiding some risk is going to pose threat to the future of any organization. So doing nothing, is probably the greatest risk in a dynamic internal and external environment. You could see some companies, they are just there, okay? Probably because they are selling well and they feel, oh, we are okay. I think Joy mentioned something similar, because we are fine, we are making money, we are just there. So there's nothing around innovation or creativity, all right? So and that's quite risky, all right? And we're going to find, take a look at some companies, that fell victim, okay? So that's the background, I think, that will suffice for what we have here this evening. Now, a lot of companies that experience, innovation success grab onto it and believe that it's their secret, right? To an everlasting success. Now, this mindset puts any company at risk of failure, but refusing, to evolve, okay? So because we are successful yesterday, may not necessarily mean we continue to be successful. So if you refuse to evolve, with the market, that can be more devastating, as business leaders, as business advisors, these are the things, we need to bring. You could see that map on risk reporting that Joy showed us earlier on, emerging risk, right? And I think in my company, I call it risk intelligence, right? So that's what I do. I think I do that on a quarterly basis. I have to tell the board, risk intelligence, is quite it's not something you can, accurately predict because it's in the future and it's not really apparent because there are no data, to probably support those occurrences. And how do you, really do that? So that's why it's quite important, as risk managers, as auditors, that you just have to keep evolving with the market space. So you could say we have strategy and value creation. Resilient business strategy, we address sustainability challenges and take into full account of all the ways the world around us is changing, okay? So that's how you build a strategy and, of course, value creation. Now, when it comes to governance, okay, the boards and senior executives, say Joy was, on point. They had the expertise, obviously, in the insights and, of course, information necessary to plan for a sustainable future over the long term, while also overseeing sustainability performance today. Okay, now when you now take a look at leadership and management, I think I also see someone, asking if leaders and managers, who are actually leaders and managers when it comes to, the three lines of defense. Okay, now you see leadership and management, that are structures and, of course, processes and relationship will exist, and make, sustainability an essential part of companies' decision making. So you don't just make decision, you think long term, right? You think long term, not just short term. Okay, there's always a problem between your tactical plan and, of course, your strategic plan, because sometimes tactical plans deals with the short-term goals and objective of a company. How do you consolidate it with your long-term plan, which is more of strategy, all right? So that's as being a challenge, because most managers, they have short-term or short period to spend in a company. How do they really take decisions in the longer term? There's always a problem between the managers, the board, and, of course, the shareholders, and that creates, conflict of interest and all of that, and that's the essence of our corporate governance. Okay, so those are the issues here. Okay, but it has to be. We have to build on that, and also build on ethical organizational culture that sustains integrity. Can you see that? So that's why fraud has to go, and that's why, as auditors, we needed to review controls, to be sure that we are not sitting on a gunpowder. Like Faye said, fraud does not really occur, at every time, but once it occurs, it's like hurricane, like he said, right? Okay, and so everything we do, sustains integrity and, of course, supports sustainability, innovation. Okay, so let's move on because of time. I like to talk, right? I can do this till tomorrow. So let me just try to control myself. Now, let me now take a look at what risk is, okay? Joy was able to tell us what enterprise risk is, or what is risk itself. According to ISO 31000, that's International Organization for Standardization, it said risk is the effect of uncertainty on objectives, right? So let me just quickly explain this, then we move on, right? So that everybody will be on the same page. So when you say risk, it's the effect of uncertainty on objectives, right? I wasn't there when you did the definition, but I think I understand what they are saying there. So let me try to break it down. Now, when you say objectives, every company has objectives. You have strategic objectives, financial objectives, customer service objectives, production objectives, finance objectives. Even you personally, you have an objective, what you want to achieve in the next 5 years, right? You want to go for a professional certification, you want to get this job, you want to do that, and all of that. So that is objective. Now, let's come to uncertainty. Uncertainty is a kind of probability. We're not really sure, whether certain event is going to happen. Okay, if it's going to happen or not, we don't know. So that uncertainty around that. Now, when it comes to, so what it means is there could be some event on my that will have impact on my objective. Now, let me give you a nice example. Now, look at what happened during his presentation, right? That was a risk that happened, right? I think he lost connection, using the laptop, but because he's a risk person, then he quickly switched into using a phone so that that will be a smooth ride, right? So that's uncertainty. At the beginning of the what's it called of the slide of the presentation, we are not sure whether it's going to lose connection, right? So that's uncertainty. So if care is not taken, it's going to have impact on the objective, and the objective is to do the presentation successfully. Can you see that? Now, Nana said risk is the effect. So when you say effect can be positive or negative. So if I pick a company, for example, I want to achieve, let's say, 100 billion naira in profit this year, 2020, that's my objective. Okay, so I now have a lot of uncertainty. For example, government policy, which could be favorable or wise, COVID-19 pandemic. Okay, so those are uncertainty. That was January 1st, 2020. So I'm not really too sure of those events that will occur in the year that will either make me to achieve my objective of making 100 billion in profit, okay, or not. Okay, now, so those are uncertainty. So when you now say effect, when it happens, it's going to have either positive impact or negative impact. So let's take, for example, government policy happened. Now look at Finance Bill in Nigeria, for example. Finance Bill was saying some companies with turnover of less than 25 million, they're exempted from companies' income tax. So you could say that could be positive risk, right? Okay, because it's going to have positive impact on the objective. They're not paying taxes, right? No, okay. Now look at COVID-19 pandemic. Now it also has negative impact on certain industries. Now look at the airlines, schools, hospitality industries. Okay. Now, but at the same time, look at Zoom. Okay. Look at this platform. For example, we are using Zoom. I'm quite sure that the projection of Zoom for 2020, they would have made it in the first quarter of 2020. That's it, because of COVID-19. So because of an uncertainty that we are not really sure is having impact, or effect on my objectives. So that's why risk is the effect of uncertainty on objectives. Now, like Koso, we see earlier, he also define risk as a combination of probability of an event occurring and the impact of its consequences. So one is a risk to happen, and when it happens, now what will be the impact? Okay, for example, let's say there was a fire outbreak, okay? And when there is a fire at your workplace or premises, what will be the impact? Okay, so if it happens, or let's say there was an earthquake, for example, those are part of external events that could affect a company. So what will be the impact? So probability that it will happen. When it happens, the impact is going to be low, is it going to be medium, it's going to be very high, it's going to be catastrophic. So that's how risk is being measured. Then realization of opportunities is a situation whereby an entity is strategically positioned to capitalize on the state of the environment. You imagine a pharmaceutical company has a vaccine for COVID-19. That's it. They are in money because they are strategically positioned. Now look at Zoom, for example. Zoom has been there, but nobody really knows Zoom. But when there was need for remote working, virtual meetings, everybody starts, asking about Zoom, and all of a sudden they came to the spotlight, right? So because they were strategically positioned. What this means is, as a company, we need to continue to innovate, right? Because some of those innovation, might not really making waves now, but in far future, all of a sudden it could come to the spotlight. But let me bring our mind to something. Risk can lead to erosion of value. That's it. Don't forget, we are talking about corporate values as well, right? Now, one singular event can bring down a company. Okay. Now, that's why risk is quite important. Just one. You don't really need to wait for so many events to occur. In fact, fraud is one of them. It is quite significant, that has been occurring over time. Now, I keep asking a question, in December 2019, for example, a company declared, let's say, 200 billion naira in profit, okay? Then COVID happened around January, February, March. Then all of a sudden, the company is no more. Then the question is, what happened? So what happened with those money? As an accountant, we understand that those profit are not cash, okay? So because companies are making money or they are declaring profit does not necessarily mean they are liquid, right? Okay, so that's on one side. Number two, what constitutes the revenue? Okay, are they cash sales or are revenue overstated? So what it simply means is they might have been window dressing the account over time. Then COVID came, they cannot survive again. That's it. So that's why if risk are not well managed, okay, or well identified, and of course managed and monitored, like they are, our speakers has emphasized, then an erosion of value can occur. That's why events may occur and we make it impossible for a company to create value or seriously reduce its capacity to create value, thereby unable to achieve its strategic objectives. You can't innovate. Even if you innovate, then that innovation, don't forget we said innovation is also risk, okay? So those are the issues here. Now, what are the assumptions about risk? A lot of people, even at the boardroom, sometimes they have so many assumptions about risk. For example, risk is just something for finance and insurance to worry about, even in companies, among employees. So they think, probably we have a finance department. So it's for them to worry about it. After all, I've insured my car, okay, so I don't need to worry. Now, that's a wrong assumption. Don't forget, we talked about ERM earlier. ERM simply means it's effected by the board and across the enterprise. So it simply means that at organizational level, even on a personal level, all of us have to be involved in risk management. So if your company has a risk department, for example, or probably have a finance department or insurance, most of your items or what has been insured, right? So that doesn't mean you are not going to be concerned. You talked about whistleblowing policy, okay? It's quite important because it's for everybody, all right? And if we really want to be resilient, within our organization, risk comes up on the agenda once in a year. That's also a very bad assumption. Gone are the days that risk is going to be discussed maybe in December, 2020 or 29 at the end of the year, all right? What are the risks that we face in the year? That's just once in a year, okay? And if you see in some companies' report, you may not even see risk information. If not in recent times, that is now becoming a regulatory issue, okay? Now, another point here is risk management is just another layer of unnecessary bureaucracy, because when we join our organization, most of us, there's nothing like risk management, okay? So all of a sudden, they're trying to, inject risk management system, and everybody has seen it as that just worry me, okay? It's just an unnecessary layer of bureaucracy. They're just disturbing me. Why do we need to talk about risk, okay? So, and that's a bad assumption. A lot of companies are dead now, okay? Because they fail, to really recognize the impact of risk on stakeholders. And another point here is risk management is about downside, not creation of value. Okay, now, so one of the objectives of this training or this course or this congress is to also show us that risk is not always on the negative side. I was able to establish that when I said risk can also be on the positive side, or probably when a company is strategically positioned, and that is where innovation comes in, right? So it's also about creation of value, because if you don't take risk, now forget return. They will say they are the risk, they are the return. Okay, even you taking up a job is a risk. There's a risk there. There's a negative risk. There's a positive risk. The positive risk could be, your salary, your remuneration, your leave allowances, and all of that. All the benefits that associate or that is associated with, those jobs are also risk, right? Okay, and the last point here, there are so many of them. So let me just summarize it here: is risk is a compliance issue. Probably you work in a bank. CBN, as the regulator, wanted us to talk about risk. Or I work in the insurance industry, or maybe manufacturing industry, maybe pharmaceutical. NAFDAC wants me to report about risk. Okay, let's just tick the box, or the SEC, that's Securities and Exchange Commission, or sometimes the Nigerian Stock Exchange and all of that. So let's just, so risk is not about ticking the box. It's something we must do. It's not a compliance issue, right? It's never a compliance issue. So it's becoming, something that we really, have to do consciously. Okay. Now, what is innovation? Because of time, innovation is, commonly defined as carrying out of new combinations that include the introduction of new goods, right? New methods of production, the opening of new markets, the conquest of new sources of supply, and the carrying out of a new organization of any industry. So that's defined by Wikipedia. And something we need to take note is this. Phil Mickney said, without a robust and resilient innovation strategy, no company can survive. Now, we could see what is happening in the environment. Things are changing. Like you noted earlier, because of COVID-19 pandemic, a lot of companies, a lot of people really has lost their jobs. Some people are on pay cuts. Now look at the inflation rate. You could see the value of Naira, currency devaluation, everything. Okay. Now, the same thing that affects individual is also affecting companies. So when you don't really have a robust and resilient, can you see that? Resilient innovation strategy, then no company can survive because things keep changing. Imagine a manufacturer or a manufacturing company buying some bulk of raw material, in anticipation that, I'm going to use this material, to do 2020 production. And all of a sudden, I was locked down. What happens? Most of those material, like gas points, especially if they are short-dated materials and all of that. So that is why innovation, resilience, and operational risk and strategy, they are quite important. No company is going to survive without a robust resilience. Now, what's the difference between creativity and innovation? Innovation, we can distinguish from creativity by the emphasis on implementation of our creative ideas, okay? Amabile and Pratt in 2016, they were trying, in a literature, they were trying to, differentiate between creativity. They said creativity is the production of novel and useful ideas by an individual or small group of individuals working together. So that's creativity, just try to, bring up ideas. But innovation is a successful implementation of creative ideas within an organization. So what it means is, it is not enough to have good ideas. You just have to take a step further by trying to implement those ideas successfully, and that is innovation. And as such, they consider both as part of the same process. So they actually, have a very thin line, okay, because they are part of, the same process. Okay, so that's that. So sustaining and destructive innovation. So let's find out. Now, sustaining innovation is the improvement of a product or service based on the known needs of current customers. For example, you listen to feedbacks, in the market space, what your customer says, you already know their needs based on their current needs. So you try to, meet up with those needs. That's what they call sustaining innovation, right? For example, faster microprocessors, flat screen televisions, those because, things are changing, so everybody needs something like touch screen and all of that. So because you already, are aware of their current needs, then you try to, meet that needs. That's what we call sustaining innovation. We're now talking about disruptive innovation that is now becoming a major concern in every business sector, and that's why we are doing this. In contrast, refers to a process by which a new product or service creates a new market, e.g., transistor radio, crowd-free source encyclopedia. It is eventually displacing established competitors. Okay, so that's it. Now, something else came up, in the market, and all of a sudden, all the competitors, they cannot sell again. That is disruptive innovation. A lot of people are at the back door. They are thinking, on innovation, and your company is just sitting down, you're not even doing anything. Okay, let me give you this scenario. There was a time I was, doing training at work. I work in a pharmaceutical company, and I said, if we have what's it called now, malaria drugs that naturally you take, visitor comes on board and come up with malaria drugs that you use a dose in the morning, another dose in the evening, then you're fine. So which drug do you think people want to buy? Or maybe the paracetamol, you have those big tablets and all of that. Some innovation, some people were able to come up with tiny paracetamol, tablet, that is quite smaller and it's very effective. So those are what we call disruptive innovation. It will displace existing established competitors. And all of a sudden, you are not in the market. According to Christians, he said, disruptive innovations are critical to long-term success in business. So that's why effectively we must engage in effective innovation strategy. It's not really a smooth ride anyway, because it's something that takes a lot of time. Now, innovation risk and limitations. Obviously, like I said, innovation is not smooth, right? It's not really smooth. So there are inherent risk there, and of course, limitations. So innovation is only have a wide array of risks that depend on attempting to predict the unknown. Okay, like we said, sustaining innovation is already known. So you try and bring meet up with the market space. But here you are trying to displace or trying to come up with something that's not in existence. Okay, even though some companies have long been dictating extensively or deploying extensive resources to manage this risk, uncertainty surround innovation, continues to play. Okay, and many unprecedented innovators who jump too quickly into the market, they fail eventually. So when managers engage in the process of brainstorming how to minimize innovation risk, they generally do so under flawed decision model or in imperfect context. As a result, a number of innovation failures, do not necessarily stem from the innovation itself, but the process used to determine how the innovation is introduced. So inherently, there are limitations and there are risks when it comes to innovation. So here, but in order to be successful, when trying to come up with innovation, to successfully manage innovation risk, managers must now take adequate time. Can you see that? So that's why I said it takes time and thought to developing and improving their decision model under which they are evaluating their respective innovation. So the more reliable and relevant information companies use in making choices about when and how to introduce innovation into the market space, now the less risk those companies are assuming that they missed an important variable and consider the calculations. Okay, and of course, it's going to reduce unintended consequences. So there are a lot of time, and don't forget, the challenge here is there's no time to waste time. So how do you really match up with the market space? Because if you are too slow, there's a problem. If you are very fast and you launch, poor innovation strategy, it could be a doom for the company. So those are the challenge at the boardroom, right? And managers, risk managers, auditors, this is where we try to help organization in terms of reporting and when it also comes to innovation. Now, when I take a look at innovation and organizational resilience, when you talk about resilience, somebody is trying to fight you, right? And you don't fold your hands and you allow the person to continue to fight, you try to fight back. That's what resilience means, for an organization. Not like COVID-19, every company was, running, how do we, ensure we continue our business without necessarily, being badly impacted, okay? So that's organizational resilience. Now, organization, or companies are operating in a complex, turbulent, and uncertain business environment. You can wake up tomorrow or Monday, you just read the news, a lot of things is happening, and environmental is now creating need for resilience, which could be beneficial to the organizational, innovation. So resilience enabled by 4 preconditional resources, that is structural, cognitive, relational, and of course, emotional resources, which are particularly important in innovation project. Okay, so managing innovation will improve our organization capacity, for resilience. So resilience means a sustained superior performance. That is, resilient companies can always maintain a high performance and can self-renew over time, through innovation. So now that means when we build innovation, it has to be around resilience, so that when uncertain events occur, we are there. Even if what we introduced to the market failed, okay, we are resilient. Let me give you this scenario. You imagine, if you can remember what happened to Huawei, last year, I think Donald Trump, placed a ban on Google from supplying Gmail to Huawei. Now, when I read that news in my office, I was like, how will Huawei survive? Naturally, if you buy phones, Google, whatever, they are there by default, your Gmail, your Google app and all of that, right? So imagine stopping, Google in America from supplying Huawei, being a Chinese company. Okay, so I was wondering how will this survive? But I was, I was surprised around July this year, 2020, Huawei surpassed Samsung and Apple in terms of market share. Huawei had garnered 19% market share, and Samsung was trailing around 17%. That was in July 2020. Why? Now, the IMD said it's a case of operational resilience. Okay, so it didn't because of what happened on that event, and all of a sudden you don't hear about them again. So what it means is, when you build innovation, it has to be around resilience. Okay, and that's why you have to think longer term. Okay, so it's quite very important. So I think I've said so many things around here. So these ones are also very straightforward. So because of our time, let's move on. Now, let's now take a look at strategy and value creation. Okay. Now, the best response to disruptive technologies and, of course, new business models, changing demographic, etc., is not to continue integrating sustainability into a company strategy, okay? But to develop a completely new ways of designing business strategy and creating values. Now, you will agree with me that what works for certain companies, let's say 20 years ago, 10 years ago, is not working now, okay? It's not sustainable anymore. So that's why, you just have to develop a new ways of designing business strategy, and of course, creating values. Now, all of a sudden, there was a need for social distancing when COVID-19, pandemic was up there. Now, what happens to businesses, that they can't sell without face-to-face communication? Okay, so everybody has to now quickly resort to social media, open Instagram page and all of that, Facebook. People start, learning how to do all of that. Then corporate organization needs to start thinking of digitalization, and that's we take us to the paper 4, managing risk in a digital world. Okay, so you can see these are issues that we need to start thinking of if we really want to remain in business. And there is a link between strategy and value creation. If you have a poor strategy, how do you create value? Now, there are 3 major changes that need to happen for this new era to emerge. One, we need to create resilient business strategies that take sustainability as their foundation. That's the first thing that we need to do. Create resilience business strategy, okay, that as its foundation as sustainability. Secondly, we also need to emphasize long-term value creation. Okay, so it bothers I'm bothered sometimes, when I see certain decisions in companies, within the board or management, they are short-term in nature. We have to think longer term so that we can weather the storm of changing business environments, okay, and find ways to move beyond short-term performance pressure that can prevent progress on sustainability. And the third thing we need to do, we need tools, and approaches that prioritize and measure the impact of sustainability in a language that resonates, with our businesses. Okay, so that's quite important. Those are the three things, that can really assure us of long terminalism, and of course, a link between strategy and value creation. Now, let's now take a look at real life scenarios. I'll just give us 3 examples. I actually have about 10 companies, that I wanted to discuss. But when I look at the slide, I just have to reduce it. Okay, so I have 3 examples of companies that failed to innovate. Joy has told us some of them earlier on that also borders around what's it called, failure of risk management. Okay, so we are going to take a look at them so that we can really learn about them. I'm pretty sure we are conversant with most of these companies, but some of us, we may not really know what went wrong. So let's find out. The first one is Kodak. Okay, I'm sure you know Kodak, right? All those things, photography and all of that. So Kodak is a technology company that dominated the photography film, market during the 20th century. Okay, so the company believed its chance, to lead the digital photography. You don't even need a photographer now, I'm sure, Abby. Your phones can, do photography and all of that. It's only maybe when you have a big event, you start thinking of maybe a photographer. And you can see sometimes when you go some years back, when you go to take picture, it's either you invite a photographer to your house or you go to their shop. It takes a number of days, maybe 2, 3, 4, 5 days before you get your picture. But now, all of a sudden, we have something like wait and get passport, and now you can even, do it in your house and all of that. You could see, changing business environment around photography. Now they blew their chance to lead digital photography revolution as they were in denial for too long. Okay, Steve, one of the execs said, one of the engineers actually invented, the first digital camera back in 1975. One of Kodak engineer invented the digital camera. Do you know what he said? He said, but it was filmless photography. So management reaction, because it's filmless. You know those films now, when you want to do photography, you're using films. But this was digital, so there's no need for film. You know what he said? He said, that kills. Oh, that's fantastic. That's actually an innovation. But don't tell anyone about it. That's what he said. So they innovated, there was an innovation going on. All of a sudden, they killed it. Is that what we call glass ceiling? Or is it that probably they're thinking if they should present it to the board, or sometimes somehow he's going to get promotion or he's going to shine? I don't understand. They killed it. Okay. Now, what went wrong? Now, the leaders of Kodak failed to see digital photography as a disruptive technology. Did you see that? It would have displaced all film photography in the market. That's it. And they will be the leader, and all of a sudden they might even monopolize the market, except, those other companies or competitors were able to also master that digitalization. A former vice president of Kodak, Don Strickland, says, we developed the world's first consumer digital camera, but we could not get approval to launch or sell it because of the fear of the effect on the film market. The management was so focused on the film success. Can you see that? So sometimes you don't have to rely on innovation success in the past. You just have to keep innovating, okay? So they focused on film success that they missed the digital revolution after starting it. Kodak filed for bankruptcy in 2012. That was it. Can you see? That's a devastating effect at the long run. Now, look at Nokia. This is a very classical case. I'm pretty sure most of us, we are aware. This is where Nokia started. Nokia connecting people. As far as I know, at some point, Nokia had more than 70% market share of the whole world, in the whole world. Yeah, when it comes to phone industry. You know, now I think Samsung, the iPhones, Apple, and probably Huawei, they're just, managing to, compete. But Nokia was standing. Nokia is a company founded in Finland and was the first to create cellular network in the world. So in the late 1990s and early 20s, Nokia was global leader, in mobile phones. Now, what went wrong? I'm sure you know a lot of news around Nokia, right? Look at the MD, he was crying, when eventually Microsoft, is buying or acquiring Nokia. I said, we didn't do anything wrong, but somehow we lost. They actually did a lot of things wrong. That's innovation. The resilience or let's say the sustainability. That's why we needed to move beyond sustainability. That's the sustainability around Nokia was two things. Okay, number one was the what's it called, the battery life of their phone and the durability of their phone. That was sustainability. The question is, for how long will it sustain them? They were not resilient. That is why we are talking about risk and resilient innovation strategies. Can you see the difference now? So it's not enough to be sustainable. The question is, how resilient are you, even if what you think has been sustaining you can no longer sustain you? Okay, so that was the issue here. So Nokia mistakes was the fact that they didn't want to lead the drastic change in user experience. The issue here is, those phones, you have to press button all of a sudden. You have to, touch screen phones. Then all of a sudden, you want to unlock your phone, you use the password, sometimes PIN, sometimes pattern. Now you just, your fingerprint can open your phone. Some sophisticated phone, just your facial expression, your phone is going to open. Okay. But this caused Nokia to develop a mix of operating system. So when Android came, and they just have to respond, they now came out with Windows Phone, and that was a mess. Cannot even, enter the market. Now the company overrated their strengths. That's its brands, okay? And they believe they could arrive late in smartphone game and succeed. So in 2017, Steve Jobs launched iPhone and a phone without a keyboard. I'm sure you have seen that, right? Which was revolutionary at that time. So in 2008, Nokia finally made the decision to compete with Android, but it was too late. So the products were not competitive, and that was Windows phones. Now, at that time, Nokia was about 50 billion, but it was sold for $7 billion. Can you see that? That's market value at 50 billion. Why? They failed to innovate. Okay. Now, it wasn't just Nokia failed. It wasn't just that Nokia failed to recognize the increasing importance of software, though. It also underestimated how important, the transition to smartphone will be. And this was in retrospect. Can you see? A classic case of a company being in charge. So they're happy. Hey, we are there. We are making the money. Okay. So that was the issue here. And in a way, it imprisoned them. So they were imprisoned by past success. So that's it. The company is really making a lot of money. Every year they increase salary, everybody's happy. You need to keep thinking. When I was doing a presentation, during the year, all these webinars, I said, even Zoom, they need to start thinking because it cannot go for forever. It can't. I'm pretty sure the demand for Zoom might have been sliding down, okay? Because all of a sudden, actually maybe in this part of the world anyway, all of a sudden there's no COVID again, and all of that. So what happens to Zoom? So the money, they made, but probably those money they've made this year that they've not made in the last 3-5 years combined together, how sustainable will it be? So the question now is the resilience angle to innovation. Okay, now the third one is Xerox, right? Because Xerox was actually the first company, to invent PC, and their product was way ahead of its time. So unfortunately, the management thought going digital, can you see, would be too expensive, and they were never bothered to exploit the opportunity they had. Just like Kodak, that was it. Okay. Now the CEO, David. So what went wrong here? Was convinced that the future of Xerox was in copy machines. The digital communication product invented weren't seen as something that could replace the black marks on white paper. Xerox failed to understand that you can't keep perpetually making money on the same technology. That was the problem here. You can't. How? How do you do that? Even natural, products, that's why they have life cycle. It can't be in the market forever. It's not possible. You can't. You need to keep innovating. If you are a lecturer or a facilitator somehow, you need to keep thinking, how can I improve on my delivery? Okay, what's my delivery strategies? Because when people are used to, one way of communication, one way of lecturing or facilitating, and all of that, it will all of a sudden you just see that nobody is interested again. So you need to keep thinking. That's why you need to keep innovating. So as a company, as risk manager, as business advisors, these are the things that has to form, part of our reporting, and we advise the board or the management, as it were. Okay, they think working on the same technology or making money on the same technology is going to, they are there, like it's going to be there forever. So that was the issue here, okay? And of course, so that was the issue with Xerox. Now let's move on because of time. Resilient innovation strategies for innovation for corporations. So what do we really need to do around here in order to successfully manage innovation risk? Managers must take adequate time. We said that earlier, and thought to, developing and improving their decision model under which they are evaluating their respective innovations. Time is key. Now, the more reliable and relevant information companies use in making choices, about when and how to introduce innovation into marketplace, the less risky, okay, or risk those companies are assuming they missed an important variable, to consider in their calculation, and thus reducing the unintended consequences. Now, let's take a look at the 5 rules to manage innovation risk. First is to recognize that a model exists and needs to be developed for judging risk and return. So that means in informing or in trying to be innovative, there must be a model you are sitting on to try to judge about risk and return. So that is very important. So because of time, let me just move. Okay, so every innovation model has its own set of limitations. So obviously, it's not fast and it's not a smooth ride, right? So they have their own, limitations, and you really need to recognize that. They also expect the unknown. So that's why when building innovation rather, it has to be resilient. Okay, you're thinking about backup strategies. Okay, so because anything can happen, so expect the unknown. Okay, and of course, the fourth one, you have to obtain, intimate knowledge and understanding of the user. So if you are trying to launch a new product or service, then what did they really? You must understand, or have intimate knowledge about the user. What are the qualifications of the intended users? How will the unintended user find a use for that innovation? Innovation does not necessarily mean out to be in the marketplace. It could be within a company as well, okay? Maybe the way of doing things and all of that, or some processes, really need to be digitalized and all of that. So does the user fully understand innovation applications and limitations? How might they misapply the product or service? And the last one here is consider the infrastructure the innovation will be placed in. So what are the tools that you need? What are the technology that will make your innovation be quite successful? For example, the infrastructure that the cloud has produced has altered many companies' business model. Have you tried cloud computing? Because of the need for remote working and all of that, Microsoft, they were there. Just give everybody as in just access the cloud. Why you can save your files, and anywhere you have your phones, you can log on to that mail, your company's mail, then all your files in the office, they are there already. So you need to know or find out what kind of infrastructure your innovation is standing on, so that it doesn't really collapse. Now, so let's take a look at because of time, I'm able to do this. So this is just criteria, for understanding stability and of course, adaptability in innovation process. Okay, so maybe when you add material, you can just, go around here. But of course, culture is key, leadership, and of course, teamwork. Okay, so, culture, when they say culture is a way of life, okay, so that's why, and to build culture, it's quite difficult sometimes, especially organizational culture when it comes to, risk culture and all of that, okay, tone at the top, is always a problem, even leadership. And I like that question put up by Faye the other time, asking whether, strong ethic around the public sector. Okay, so now those are the issues. Okay, but here you could see how companies can be stable and also adapt to, innovation strategies. Okay, so because of time, let me just move on so that I don't take much of your time. So, like I said, we also have cases of resilient organization. They faced turbulence. Okay, but they were resilient, probably because of their strategy and resilient innovation. So you could see here how we have um, Tencent and Hire, and of course Neurosoft. Okay, so you see their main business lines, the environmental turbulence. Now Huawei faced competition, from excellent global companies and uncertainty in the development of information and communication technology. Okay, so that was the issue there. So what they did was they continuously improved their operating performance and investing heavily in research into technology and business model. I made mention of why the other time. Imagine stopping supply of Google app, Google everything, to Huawei. You could see devastating impacts it's going to have on their performance, okay, and on their brands, okay. But one way or the other, they were able to scale through. So those are the cases of resilient organization. Now, for IAD, decreasing demand as a result of slowdown of macroeconomic growth. Those are the things that are not really within the control of companies. Okay, intensifying industry competition. Okay, what they did, networking strategy. That's what they did. You could see some products they have to start selling via networking because they just have to be resilient. So that's what they are doing. Then you see Tencent, their own issue was the advent of mobile internet era, okay, and that migrates social communication from personal computers to mobile terminals. Can you see that? Gone are the days that if you want to make calls, you have to probably go to a phone booth, and all of that before you can make up. But now everybody now has mobile devices. You see where is Nitel today, for example. So those are the issues around there. But they are resilient, establishing internal entrepreneurial, disruptive, and innovative activities to proactively build a social network platform. You see, during COVID, a lot of companies went into other businesses, okay, because what they are doing currently is no longer sustainable just because of COVID-19 pandemic. Now you can see GoCada, for example, when there was a ban or they placed a ban in Lagos, they just switch into delivery business. But where's OPay today? Where's OPay? So that's why you need to be, you need to consider risk and resilient innovation strategy. Okay, so that's very instructive. Okay, so these are the factors of innovation resilience. For example, core identity and commitment, employee well-being, because it's not a board issue alone. Because like Faye said, we needed help. Is a teamwork, all right? Long-range innovation strategy, core technology capability, formal mechanism and platform. Clear rules and regulation, supervision, and monitoring. Effective communication is very key. Supportive and of course innovative culture. In fact, in some companies, what do they call it now? Is it culture now or ethics? Slogan. They also have innovation as part of it. In fact, some companies they do reward on innovation. People that come up with new ideas and all of that, and they were successfully implemented. Risk-taking culture for innovation, employees self-directed learning. Leader mindfulness, concrete or concentric diversification is also very key. diversified talent, so because of time, I may not be able to dwell on that, on most of these, but I'm sure you should understand that. Then, flexible organizational culture or structure, the flexible authorization mechanism, then open innovation, and of course, cooperation. So those are things that will help, in innovation resilience. So what are the action plan, for corporate organization? You have to focus on separate sustainability strategies, focus on separate sustainability strategies rather than business strategy. So business strategy is no longer working. So you have to think of sustainability. Then beyond sustainability, you think of resilience, right? Then setting sustainability priorities that are driven by risk management. Obviously, risk management is resilient in nature. If you do risk management, you're already technically doing resiliency, right? And of course, the third one here, being constrained by investor short-termism, right? So that's the way most managers think, short-term objectives, and it's a serious issue. Then you innovate, create resilience business strategies, can you see, that view progress on sustainability as a means of long-term value creation and of course innovation. Then conduct scenario planning and strategic foresight. How many companies are doing scenario planning? It's quite difficult anyway, but it's something we can embrace. So as risk managers, you can also, or auditors, if you do risk as part of your job function, you can also create or include scenario planning in your reporting. So it will also help the board or whoever in charge of governance to, make, concrete decisions. Okay, so that is very, very instructive, as it were. Okay, sorry. Okay, then also engage investors in long-term vision of the business. So this is also very important. So let's do some conclusion. Now, innovation, by its very nature, is a risky business. We established that earlier. That requires attempting to know the unknown. So accepting this fact and having a strategy in place to mitigate risk is critical to being a successful innovator. So using these 5 basics that we said earlier, companies will be better equipped to tackle many of the risks related to innovations, that go unaddressed. And of course, resilient business strategies are based on understanding that the rapidly shifting external context, that's the bone of contention here. Things are changing demographics, destructive technologies, economic dislocation, and natural resource scarcity are not only sustainability issues, but also business issues, because these are having direct impact, on the survivor of an entity, okay? And of course, resilient business strategies are based on the view that issues such as climate change, women empowerment, and the changing nature of work are not only for sustainability strategy, but are issues of business strategy, a crucial conversation for the boardroom. Okay, so before we go, let's take a look at this quote by Winston Churchill. He said, "Without tradition, art is a flock of sheep without a shepherd. Without innovation, it is a corpse." Now again, Roberts said, "The only way you survive is you continuously transform into something else." It is this idea of continuous transformation that makes you an innovation company. Thank you for your time. Thank you so much. Okay, so let me hand over to my host, my moderator. Let's see whether we have questions. Thank you.
Wow, wow, wow. It's been a very wonderful evening. I want to thank you all for staying with us tonight. Thank you very much, Mr. Ayomi Ladoku. It's been a very, very beautiful presentation. I have learned a lot. I believe every one of us here have learned 1 or 2 new things. Risk is the effect of uncertainty on objectives. I used to argue with one of my risk professional friend who, as far as I'm concerned, has been very pessimistic, I would say. And I've always asked him, like, you risk professionals, are you guys always like this, thinking of the negative effects, negative impact, negative here and there? And he took time to explain to me that, no, it's not all about negative. But now Ayomi has really proved to me that there are also the positive sides of risk. And of course, this relationship between risk and return, if you intend to have your returns, you should be willing to take the risk. Thank you once again, Mr. Ayomi Ladokun. Thank you, every one of us, for staying tuned. At this point, we would love to entertain questions. If we have comments, questions on whatever area as regards the papers that have been presented tonight, let's do so and ask quickly. I think I have one question. Ayomi. Are you with me, Mr. Ladokun, please?
Yes, yes.
Okay. In an organization where there is no, because from all you've said tonight and from what Faye and Joy have also said, I think risk department is a necessity in every organization. Do you agree with me on that?
Yes.
Okay, in an organization where we don't currently have such a department and you as an individual want to try to talk with the board or the management to see how such a department can be created, what are the first few things you need to do, or what information do you need to arm yourself with for a start?
Okay, that's a very brilliant question. So you work in an organization and there's nothing like risk department, and probably because you've done a training or probably a certification in risk and you're seeing the benefits, of risk, to your company. And how do you really convince your board or probably management, to try to embrace risk? It's quite difficult. But obviously, you're going to be a salesperson. A salesperson, one way or the other, that has a target. We have to convince people to buy. Okay. Now, the first thing you have to do is you start talking risk. For example, if you're having conversation with people around you, then you start talking about risk. You start, start to do personal, assurances, personal conversation. Maybe if you do some reports, a little bit of, risk elements you input into that reporting, then all of a sudden, if you have a face-to-face conversation, with your boss, you also put it in. Then you start talking. Now there'll be a day, maybe most likely, they can invite you probably to come and present to them the impact of risk on the organization. So now you just have to equip yourself with training, reading risk magazines, reading about companies that failed, and of course, bringing out those issues so that your company, does not even fall into that trap. Okay, so, but like I said, you just need to, believe in it first. So if you don't really believe in risk, there's no way you can convince people over there. And there's this issue of ethics, right? So some people, they may not really want things to work because most likely that's how they are making it in the organization. So they may not want to embrace risk because it's going to be very difficult. So except, the board is, now coming or descending. That's why, Joy was able to establish that it starts from the top. So it's actually, top down. Okay, so that's very instructive. Thank you. That was a nice question.
Thank you very much. Thank you so much. Thank you for that. We have one question here from Sahid. It says, in your lecture, Mr. Ayomi, you made mention of the fact that risk is not a function of compliance officer. Whose function is risk in a corporate organization?
Oh, okay. Okay. Let me say this. It depends on the structure of the organization. In some companies, risk is merged with internal audit or compliance department, okay? So that's why you see risk and compliance department or audit and risk department, whereas in some bigger companies, risk is actually separated from internal audit, okay? I've been to an interview and somebody asked me, who does a better job between a risk manager and an internal auditor? That was a nice question. And my answer was, nobody does a better job, because you're actually doing two different things, but you're achieving the same goal, okay? So obviously, a compliance officer can also double as a risk manager. However, it could be so, cumbersome sometimes, or you may be mixing it up, okay? So that's why most companies, they separate it. And that's why even if they don't really separate it, they can have somebody in charge of risk, which is a risk manager, and the other person as the audit manager, okay? And both of them can be reporting to one single person that manages risk and of course compliance department. Thank you very much for that question.
Okay, thank you so much, Mr. Ladokun. I hope that clearly explains to you, Mr. Sahid Sikiru. I hope you're okay with that response. Just a moment, I'm struggling with my network here. Okay. Okay, if we don't have any more questions at the moment, I'd love to remind us that Sisters Consulting, they're not relenting at all in their efforts to ensure that we improve and broaden our knowledge as far as risk management is concerned. To this end, they have put together an enterprise risk management system implementation training course, which is targeted at business owners, business leaders, risk professionals, and all other interested professionals. It's going to be a very interesting, innovative, and educative package. And I want to encourage every one of us to do our best to ensure that we participate in that forthcoming training. It's scheduled to hold on the 14th of November. That's exactly 2 weeks from today. Thanks again, Six Stars Consulting. Thank you to all our speakers. Thank you, Mr. Ayomi Ladoko. You'll agree with me that it's been a very long night for us all. I just wish we could go on and on for as long as we can take. I'm convinced that we are better off, we're better informed in areas of risk management and fraud risk assessment and strategies, as better informed now than we were before this webinar. I want to crave your indulgence that we may not be able to deal extensively with the last paper, but I will call on our speaker, Mr. Ayomi Ladokun, to tell us one or two things about on the topic managing risk in a digital world. Mr. Ayomi, very quickly, please.
Okay, thank you. Okay, thank you once again. Thank you for staying tuned with us. It's been very nice. And like she said, it's been a very long night, okay? The last paper before us is managing risk in a digital world. But obviously, this is, I would say this is the biggest paper. And even myself, I've not fully digested the paper, okay? So obviously, I may not be able to take it, even though the material is ready. Okay, but let me just show you one or two things. Then in the next 5-10 minutes, we'll say good night. Managing risk in a digital world. We've established that risk is everywhere. And of course, the world is moving to digitalization. So that's not a news. And as corporate entities, as risk managers, as auditors, as compliance personnel, what are our roles, in ensuring that our organization, our company, do not mess themselves up when it comes to digitalization, and how do we really manage risk around digitalization? So I'll just tell you the training objectives, then I will hold on that, because maybe maybe in November or December, or probably next year, I'm going to reschedule this training and we're going to look at it extensively. But in the meantime, by the end of this course, we will be able to know reputation. Why reputation is one of the biggest or largest concerns in the boardroom. We're going to find out, and we're going to also see risk that can impact reputation, including but not limited to cyber attacks. Joyce said earlier that the focal point now is cyber issues, social media, and failure to meet customers' expectation. Then digital risk, digital technology, and the fourth industrial revolution. Okay, and of course digital disruption, that's societal, and of course competition. Then the current state of digital technology. Then blockchain technology and cryptocurrencies. Oh, okay. Then, of course, building risk management into decision making to ensure that your company does not get digitally or digital technologically wrong. So those are the things. That's why I said it's quite loaded, so I don't want to, it's also risky. There's something we call information overload. So we've had enough, this evening. I don't want to go into this, so maybe in the next 1 month, few weeks, I'll take time, probably represent this, and we're going to find out. So over to you, my host. Thank you.
Thank you again, Mr. Ayomi. Of course, we would have been suffering from knowledge overload tonight if you had gone further than this. But we thank you so much for the very beautiful presentation. Thank you to Joy and Faye as well. And thanks to our audience for staying with us this long. Very quickly, I want to encourage those of us who are currently sitting for the ICANN exams, a first choice accurate put together a 4-week intensive revision class to assist those of us sitting for the exam. It's going to kick off on the 9th of November. We'll get further details from our organizers. Thank you again for staying with us. I think we have 1 or 2 questions here. Okay, well, we'll liaise with the organizers to see how we can get that across to you in due time. Okay, I think that's all we have here tonight. Wow, I have learned a lot. I don't know about you. I'm convinced you have as well. I have learned a lot tonight in areas of risk management, fraud assessment, and all. Thank you so much, Sisters Consulting. Thank you very much, our audience. I want to encourage us to hook up with us next time for more interesting and more educative packages for us. Thank you so much for being with us tonight. Thank you, everyone. I don't know if we have 1 or 2 more words from Ayomi Ladoku before we call it a day.
Okay, I want to appreciate everybody for signing on. I was really surprised by the number. It's very encouraging, and my thanks also go to our speaker, Faye and Joy. They really wonderful job. And to our moderators, some people are just making comments and they are saying fine faces. Okay, that's interesting. So thank you very much for everybody that signed on. And for the materials, you're going to get it and the video recording. So we'll send it straight into your email in the next 48 hours thereabout. So you can, take a look at them again and see how you can improve your impact, your positive impact on your organization and even personally. So I want to say thank you. And don't forget the training that's coming on November 14. That's ERM implementation training course. And of course, for people preparing for ICANN December exams, that's also going to be Zoom lectures, online that you can also sign on. And I want to wish everybody a very beautiful night rest. Thank you.
Thank you, everyone, and have a good night.
Thank you.